Avoid paying unnecessary taxes. In this episode, we're going to talk about the biggest mistakes people make where they pay way more tax than they needed to, what I call unnecessary tax. And you're going to be blown away with simple things you can do to redirect otherwise payable tax to causes you support, maybe your future and your retirement. So I'm Doug Andrew. I'm here in my radio studio right now, and I've been blessed to have a radio show for 12 years. I've been on several TV shows. I've written several books. And this is a huge topic. Usually on the radio, I will say to my audiences, you know what? I can usually look at somebody's tax return or 6 numbers on a financial statement, and within 2 minutes, I can tell what they know and what they obviously don't know, how much of a fortune they're missing out on, and how much unnecessary tax they're paying or they're going to pay on some of their investments or their tax-deferred IRAs and 401ks. People come in and they say, here's my tax return. What's it going? And all of a sudden I go, oh my heavens. I can usually look at those and my brain, because I've done this for over 45 years, goes, oh, this couple in retirement will pay about $320,000 of unnecessary tax. Now, could I just share? I'm a red-blooded American. I think we should all pay our fair share of tax. But I've also talked to hundreds of thousands of people in 85,000 hours in my lifetime. And it doesn't matter whether they're a Republican or a Democrat. Whenever I put up on the screen a pie chart, and I go, now, I'm not going to fill in the pie chart. Here's a list of where the major places our government puts our tax dollars. Now, if you could voluntarily choose where your tax dollars, because most people shell out between 20, 30, 40% of their income in taxes. So that's a lot of money. If you could allocate where you would put that, if you chose, how much would you put in this category, how much for transportation, how much for military, how much for this, infrastructure, and it never comes close to where the government allocates our tax dollars. I don't care. I say, well, could you, if you wanted to reposition that, could you do better with that money and help America even more by you being able to choose where that money goes? Oh yeah. So see, it's not really a political thing. It's hey, what happened? What got us to the point we are at? So I've never met anybody who, if they had the choice, could opt to redirect otherwise payable taxes to causes they support, and when they understand the impact, it will actually help out this great country far more than just rolling over and paying more in unnecessary tax. So I'm going to go through the 3 bullet points on an article because I wrote an article and I went through this on the radio many times about the 31 flavors of missed fortune. 31 flavors is like Baskin Robbins, right? And so there's 3 under tax planning that are critical. And I'm going to go through each of these one by one and sort of give you some insights on how people miss out on fortunes because they're shelling out unnecessary tax. So this first one is so obvious to me, almost elementary, but you wouldn't believe how many people do this. I'll read it directly. Not claiming enough withholding W-4 allowances to get the proper tax refund, or let me reword it, you're letting your savings account be Uncle Sam. What do I mean by this? So many times when I ask people, well, let me see your tax returns, it looks like you're getting a big tax refund every year. Oh yeah, I'm so grateful. President Obama gave me this money back. And I'm going, he had nothing to do with that. Now, wait a minute. You think this is a generous refund from the IRS on your tax return. No, that's your money, and you gave it to them for a year for them to use, and now they are having to refund what you overpaid. And how much interest did they credit you? 0. The government has used your money for a year, just like your bank uses your money, only a bank at least pays you a little bit of interest. The federal government pays you a Zippo. Some people say, well, this is my forced savings. This forces me to save, and I get a big refund. And I go, you like savings at 0%? Come on, discipline yourself. Don't give them in withholding on that W-4. Don't take the lower exemptions just so that you have a forced savings. I would watch, and if you're getting a constant refund of $2,000, $3,000, $5,000, don't let the government use that money for a year at 0% interest. Redirect that. When I show people, take that $300, $400 a month. Don't give it to the government in a withholding on your paycheck. Put it over here in a real savings where you can earn 8 to 10%, and at the end of 30 years, they're flabbergasted. Guess what? Sometimes it ends up being $250,000, $500,000, an extra $1 million. Whereas, you know what most Americans do? It's their forced savings, and then when they get the refund after April 15th, when they file their tax return, they go spend it. They don't save it. They go, oh, we can now go buy a car. They consume with it. No, use wisdom, redirect that money that you are giving unnecessarily to the government. Just take enough exemptions so that you don't even if you have to cough up a little bit, you do not have to pay a penalty at the end of the year if you owe more in tax. You can always take that money out of the side fund as long as you've paid them equal to what the previous year was, even if you have a banner year. So don't do that. So what's the next big bullet point in my article about these flavors, these ways that people miss out on fortunes because they pay unnecessary tax? Not maximizing tax deductions and itemizing them on your tax return. Now, unfortunately, with tax reform, we've seen a lot of deductions, even clear back in 1986 under the Tax Reform Act under President Reagan. He was trying to simplify the tax code. Now, actually, the code maybe was this thick before, and after they simplified it, it was 2 volumes this thick. But the government giveth and the government taketh away. What President Reagan was trying to do was simplify how we file a tax return and pay tax. So he reduced about 6 or 7 tax brackets down to 2. Back then, in 1986, there was a 15% bracket and there was a 28% bracket. Now we're back up to like 6 or 7 again, because tax revenuers always say, well, the more you make, the more we're going to take. And so they say, you know, people with a lot of money should be paying more and more and more. And 85% or more of taxes are paid by the top 20% of income earners in this country. They do pay, in my opinion, way more than their fair share. You don't want to penalize the people who have the money because they're usually the ones who are providing the jobs and so forth. If you tax them to death, they have to lay people off. They will not expand their businesses. And a lot of economists or politicians who think they understand economics, or they think they're an economist. They don't understand that when you raise taxes higher, why we go into recessions and people, and unemployment goes up because people lose their jobs. So what you want to do as we talk about this is make sure that you can maximize deductions. So one of the things I've always done is kept my home mortgage interest deduction as high as possible. And if you watch the episode on real estate management, I keep my real estate mortgage high because it's a simple interest declining balance tax deductible. I borrow money at 4.5% and it's a net cost of 3% after the deduction. Why would I want to kill that deduction by sending extra principal payments to the mortgage company and kill that tax deduction? No, I keep my tax deduction high. In fact, I usually refinance my properties at least every 5 to 7 years, and I keep the tax deductions the highest ever, and I keep that equity separated, earning 100 to 200% greater than the cost of the mortgage. I earn in my favorite vehicle, where it's liquid and safe, I call it the laser fund, 9%. That's 3 times the net of 3% I pay on the mortgage. So people sometimes kill their deductions. This is a problem where people try to save for retirement, and they put money in tax-deferred IRAs or 401ks. Maybe that's the foot on the gas pedal going down the highway, trying to achieve destination of financial independence. They have the other foot on the brake pedal. They're paying off their mortgage and killing their deductions. I wouldn't recommend driving like that. But a lot of people do that financially. And then when they hit retirement, their deductions are all gone. The kids are all gone. They don't have those anymore. And so they're paying as much or more in tax than they ever did when they were earning money, even if they have less income, because they killed their deductions. Make sure you maximize those deductions. There's all kinds of ways to do that. When you sock away money into retirement accounts that give you a tax break, there's good ways, better ways, and best ways. I've never owned an IRA or 401k, never will. Never owned a Roth, never will. My favorite vehicle has all the benefits of a Roth and a whole bunch more, and I call that the laser fund. But see, it has tax advantages. It's totally tax-free. But when we talk about itemizing, when you can make sure that you are dotting your I's, crossing your T's, you don't want to take any deductions that are not legitimate, okay? What's the difference between income tax avoidance, which is what I'm talking about, and income tax evasion? What's the difference? About 10 years in prison. Okay. See, if I was in New York and I was over on Long Island and I wanted to go over to Manhattan, maybe there's a toll bridge, and that's the route that's the quickest. Now, you can pay the toll and go over, or else you can go an alternate route and not pay a toll. I'm talking about alternate routes, but if you try to break through the toll gate, they're going to nab you. They're going to arrest you. That's income tax evasion. So make sure maximizing deductions and itemizing where you can by using a proper tax strategist is key. I've done this for many, many people and saved them $250,000, $500,000, $1 million of unnecessary tax with tax strategies, getting the money out of their IRAs or 401ks with the least tax impact in today's lower rates, and then offsetting the taxes by resurrecting deductions on maybe apartments or rental homes that they were paying off the wrong way, remortgage them, separating the equity, earning 3 times the cost of the mortgage, but resurrecting deductions. I'll cover the last point next. So the final mistake with taxes is people not understanding the difference between taxed as earned investments, tax deferred, and totally tax-free. See, if you put money in a bank or a credit union with after-tax dollars, in other words, you earn the money and you pay tax, it's withheld from your paycheck, whatever, and then you put it into a bank or credit union and you pay tax, or even a mutual fund, on your interest or your dividends every year, that is the worst way to save and the most common way people save in America. Let's say you started out with $1 and that dollar was going to double for 20 periods. In 20 periods, you could have had $1,048,000 if it was tax-free. But if it's taxed as earned, in a 33% tax bracket, you'll only have $27,000. Tax deferred would be an IRA or 401k. If that dollar doubles every period for 20 periods, it'll be worth $1,048,000, but that's not all your money. If it's in a tax deferred IRA or 401k, at least 25 to 35, maybe 40% of that belongs to the government. That million's not your money. Only about 600 to 700,000 of that is your money. So you're only netting that much. If you pull out 100,000 a year, only 60 to 70,000 of that is yours. The rest belongs to the government. Well, I prefer to sprint towards my retirement, and so that's why I use totally tax-free investments, what I call the laser fund. So I'm able to get deductions and maintain them indirectly, and then I'm able to accumulate my money tax-free and then access it tax-free. I don't have to pay tax in retirement. If I have $1 million, I can pull out, because I've been averaging 10.07% rate of return, that's $100,000. I pull out 100,000, I net 100,000. It's totally tax-free. When I ultimately die, it blossoms in value and transfers tax-free. So what you want to do is use the proper vehicles that are totally tax-free, not just tax-deferred, or heaven forbid, taxed as earned. So, in this episode, I've talked about how to redirect otherwise payable taxes and avoid those 3 biggest mistakes of how people miss out on fortunes. If this is resonating, I would encourage you to watch this episode, and you'll understand all 31 flavors in a nutshell, and then you'll have a chance to get a free copy of my book, The Laser Fund. I'll send it out to you. You just cover shipping and handling, and you can learn more how to avoid these mistakes so many Americans unnecessarily make.